All right, I think we'll get started. Good morning, good afternoon, everyone. Hope everyone is doing well. Thanks for joining us today. I mean, it is still very interesting, very uncertain, and very volatile times for commodities markets, and we have actually have quite a few things to talk about today. I mean, when we look at oil, oil prices were up on Monday and then down yesterday and then up again today. And obviously we do have a lot of uncertainty around the Russian invasion of Ukraine and the Russian oil and gas flows. Yesterday we had the news that the European Commission may include sanctions, direct sanctions on Russian oil and gas in the next and sixth sanctions package. I mean, meanwhile, lockdowns in China mean pressure on oil demand, but then US stockpiles declined again. Also yesterday, I mean, we saw the IMF revise down its growth estimates for 2022 and 2023, which probably means that we will see the IEA also revise down its oil demand growth forecast following that. So a lot of moving parts and in different directions, and markets obviously continue to be driven by headlines, leading to very high and heightened volatility. I mean, we'll discuss some of the highlights from what we've been looking at in the last couple of weeks, but I want to remind everyone, if you have any questions, please put them in the chat. We will, I will do my best to keep an eye on the Q&A there. Hopefully we'll have some time at the end of this call to answer some of them. If we don't, we will do our best to get back to you on your questions after the call. So, I mean, I mentioned oil. I'd like to start with oil, and I'd like to bring on Will Hares. Will, so on the oil market, I mean, I mentioned the European Commission's kind of consideration for the next sanctions package. I mean, what is their latest position in terms of further sanctions? And if we do get, I mean, I guess we don't know yet, but if we do get direct sanctions on Russian energy, would we get a major market reaction at this point?
Yeah, thanks, Al. So as you mentioned, the EU Commission has been discussing a potential sixth round of sanctions against Russia over its invasion of Ukraine. And most notably, this may include an oil embargo. But I think it's important here to stress that this remains deeply controversial among the group, particularly for those countries that are highly reliant on Russian oil imports. So this is namely Germany, Hungary, and Austria, and a few other smaller ones. An EU oil embargo could restrict somewhere around 3 to 4 million barrels a day of Russian oil. This would obviously significantly tighten an already tight physical market and would, in our view, pressure higher oil prices to somewhere above our extend scenario, which is about $120 per barrel. I think we are just below 110 Brent right now. I think also that if Europe does decide to move forward and is able to get all countries on board, we would expect a gradual phase out for an oil embargo rather than immediate ban. This would be similar to the approach that the EU took with their embargo on Russian coal. But I think more broadly, we continue to see that the EU's position as it relates to Russian energy imports is looking just increasingly untenable. This is number one, given the limited prospect of a near-term peaceful resolution in Ukraine. Number two, the evidence of Russian war crimes and atrocities being committed against civilians, which we think is going to be a red line for continuing energy purchases, and then of course the asymmetry here that we see financially between the aid that Ukraine is receiving and the payments that Russia is receiving for energy that is coming into the EU. So we see that this position is likely very challenged for it to be sustainable in the near term. And obviously we're just talking about oil, but gas as well. I think Pat might be able to expand on this as well. Obviously, gas is more difficult for the EU to embargo, and we don't expect that. But it's almost certain that we see increasing restrictions, whether this is in the form of an immediate or phased oil embargo, and as rapid as possible reduction of Russian gas imports into the EU.
Mm-hmm. Yeah, that's very interesting. And we talked about the oil price scenarios. We had three in our call a couple of weeks ago. But could you very quickly remind us of where we see what level we see oil prices at in each of those three scenarios?
Sure. So we had three scenarios based on sort of contemplating the geopolitical outcome from Russia, Ukraine. Our first was an ease scenario. So this outlines an immediate easing of conditions on the ground, which is obviously clearly very unlikely at this stage, and that carried a $90 barrel pricing, which is somewhere around where we were at right before Russia's invasion. We had an extend or base case scenario, which is around $120 a barrel Brent, and this carried the just continuation of existing geopolitical pressure and situation on the ground in Ukraine. And then, of course, our sort of high case scenario, which was escalate. This would be including an expansion of the war, perhaps NATO involvement, and almost entire cutoff of Russia from most of the Western commercial world, including energy. And that was about at $160 barrel or above.
Yeah. Okay. So thank you. So I mean, we seem to be somewhere between easing and extend in terms of pricing for Brent. And you did briefly mention gas and gas prices, and for that, I'd like to bring on Patricio. Patricio, so like, can you give us a quick roundup of on where the gas prices are in Europe? And I mean, I think Will did a really good job of laying out what our scenarios were, and I think for the same three scenarios, you had some ideas for where gas prices might be. So if you could elaborate on that, please.
Sure. So I won't echo what Will explained in terms of the geopolitical situation, but in terms of the scenarios, just for context, natural gas is trading at about 98 euros per megawatt at the moment. And with that, let's jump into the scenarios. The E scenario, which is the rapid de-escalation, we saw prices between 70 and 80 euros, whilst the extend, which seems the most probable scenario, is 110 to 130 euros per megawatt. And finally, the escalate, which would entail significant disruption of gas flows from Russia. That would be anywhere from 200 to 260 euros per megawatt, with slight peaks way beyond that. But with that, let's look at the price right now. It seems like the 98 euros per megawatt seems to signal that the geopolitical risk premium is starting to ease off. As Will mentioned, it seems like the EU will not be willing or will not like to curtail gas imports from Russia, at least not in the near term, given that would probably impact the economy more at the European level rather than Russia. But it will be more of a protracted process that is likely to take a few years, given just the reliance, for example, Germany has on Russian gas. About 55% of Germany's gas demand comes from Russia, and that is interlinked with the industrial sector there quite heavily. So it seems like the prices are sort of easing and have eased about 12% since the beginning of the month. And that aligns with the seasonality of gas demand as we enter the shoulder season before the reinjection season, which coincides with the summer months. So we see that behavior as confirming our view that the geopolitical risk premium seems to be easing, and any disruption from Russian gas flows would probably not come from the EU side, but rather as retaliatory cuts from Russia in response to sanctions.
Yeah, very interesting. I mean, in the utilities space, which you cover, I mean, I thought you had a very interesting note on how, I mean, ditching Russian gas may actually hasten the European utilities green power shift. So, I mean, I wanted to ask you, I mean, how quickly do you think this is happening? And also, I mean, are you in this camp that expects this crisis to actually accelerate energy transition?
Sure. So on the first question, what we're seeing is every other week or so we see another EU country announcing a new energy plan or an update to their previous plan, which really tries to focus on improving the country's self-reliance or energy self-reliance, and that I think renewables are a big part of that, with an emphasis on solar. So as you mentioned, our note sort of focuses on how these increasing or hastening emission curbing national plans will sort of percolate into growth opportunities, especially for utilities with presence in wind and solar in Europe. And we see the larger players probably better placed to capture these growth opportunities. And this is in the context of rising inflation and supply chain issues that will probably affect the smaller developers the most. And as a sign of this, for example, today I wrote a react on SSE's acquisition of Siemens Gamesa's development unit in Southern Europe, and that's because Siemens Gamesa is facing these supply chain issues and has been forced to remove their outlook for 2022. And this is sort of this inorganic step in from SSE, just shows that these companies are willing and able to use their balance sheets to accelerate their growth targets. We saw at a national level, last 2 weeks ago, we saw the UK announces its energy plan, which sees an acceleration to 50 gigawatts of renewables by 2035 versus its previous goal of 40. And we also saw something similar in Germany as well 3 weeks ago. So we continue to see this acceleration. And of course, there's utilities that are poised to gain on the back of this. In terms of how easy or how fast we can wean or cut our reliance on Russian gas, this is something that would take years. We collaborated with Rob Barnett, our senior analyst on renewables, on a note that suggested that we could replace all of the gas demand for power generation in Europe if we invested in solar. If Europe just decided to go full steam ahead on solar, that would take at least 3 to 4 years, so a bit more past mid-decade. And that's just assuming that we get this like wartime effort to push on renewables. But this, of course, doesn't consider the current regulatory hurdles and permitting delays that continue to sort of hamper the pace of ramp up.
See, very interesting. I think we might have Rob on later on the call, so I will ask him about that note as well. But I want to switch gears a little bit because it is almost earnings season again. I mean, it's always a very short period of time between the full year results and the first quarter results. So I want to come back to you, Will, because you cover the European oil majors for BI. So I mean, I guess briefly, what are your expectations? I mean, oil prices are good. I guess it's going to be another good quarter for them. So what are your expectations?
Yeah, thanks, Al. So for 1Q, it's largely a similar story that we've been telling for 4Q as well. We saw oil prices at multi-year highs in the first quarter. We saw very elevated European natural gas benchmarks, and so we think these are the two main drivers for strong overall performance for the European energy major peer group in the first quarter. We think earnings and cash flow are again at potentially at or near records. We think that buybacks will remain the favored lever for shareholder returns. And I think watch out for further upgrades possible this year. We also don't discount potential dividend increases as well. And we would not be surprised to see positive estimate revisions across the board for this year. And so I think this is really reflected in the group's very strong 2022 free cash flow yields that are at or above 15%. This is, of course, powered by those the soaring commodity prices that we're seeing. Also the discipline that we're seeing from management teams on cash outflows. We expect gradual and cautious rises in spending this year, which still remain far below historical levels, and of course operating cost cuts. I think it is important to note here that given the backdrop we're seeing with surging commodity prices and very strong record free cash generation this year, are unlikely to slow this group's transition strategies or prompt a meaningful redeployment of capital back into their hydrocarbon businesses. And instead, we believe that the Russia-Ukraine crisis and the highly supportive commodity backdrop will provide this peer group with this cash flow catalyst, and instead help accelerate their transition growth plans. So these strategies are overwhelmingly centered on ambitious long-term renewable power targets, which will require inorganic growth to achieve. And so we think that this free cash flow step change this year will be deployed into the transition, not oil growth. And so this group's energy transition spending has averaged about 15% of total spending. We expect this to climb to 20% or above on average this year, and we expect the majority of spending for this group will be transition oriented by the end of the decade. And in turn, upstream spending we expect over this decade to continue to decline as a share of their total capex. So given the backdrop, we think that this will be an accelerant for the energy transition, which may be slightly counterintuitive for some.
Thanks, Will. I mean, I think it's going to be fascinating to watch kind of the evolution of capex by these large oil majors. Patricio, I want to go back to you. You cover utilities for us. Very briefly, what are your expectations for the first quarter?
Sure. So I'll try to summarize as best possible, given European utilities are globally diversified and are exposed to different dynamics, especially in terms of the power market that they're exposed to. What we see for large integrated European utilities, such as Iberdrola and Enel and EDP, we try and see what are the weather components that can affect short-term performance. So on that note, we saw a pretty severe quasi-drought in the Iberian Peninsula. So this will definitely affect renewable generation in 1Q. And what that entails for most companies in this space is that they will be forced to procure the energy that they could not generate at wholesale prices, which will probably be a near-term margin headwind. Nevertheless, we see their integrated business models as being able to cope with this volatility in the short term. But if we continue to see this elevated wholesale power prices, this could become a larger issue as we move on through this year. In terms of renewable focused utilities, so such as Orsted and RWE, we see, again, the same exposure to these lower wind levels in 1Q, but they should normalize and are normalizing already this quarter versus the previous year. And again, a continued emphasis and prioritization of their capital expenditure deployment. So we see dividend growth probably slowing this year as the companies are incentivized to keep on capturing these growth opportunities that we just commented on, and will probably prefer to continue their capex plans versus increasing the dividend. And this is all in the context of rising inflation as well, which will continue to hurt utilities, especially the ones that are regulated, which have a larger share of regulated earnings, given that their earnings are only partly indexed to inflation, whilst they will only be able to offset costs by less than inflation probably. So this is what we see. We see I'd say, a few headwinds for utilities in Europe, both from the power market side, weather volatility, and to a certain extent foreign currency exposure, especially to Latin America.
Cool. Thanks, Pat. And I mean, very briefly, I do want to take a minute to talk about refiners because it actually, especially in Europe, we are seeing refiners have record refining margins in March and so far in April. So I think the outlook for them, I mean, generally higher crude costs mean higher feedstock costs for them, and that doesn't bode too well with their margins. But what we're seeing is, I mean, companies like Lotos, the Polish refiner, in March had a refining margin more than $30 a barrel. It normally has a single-digit refining margin, and I think some companies in the region, especially the Polish ones, such as Lotos, PKN, and Hungarian one, MOL, which actually continue to purchase Russian crude oil at discounted prices, are actually showing very, very strong margins. So I want to bring on our senior analyst, Rob Barnett. I'm just trying to see if he's on. I don't think he is. But I want to go back to
Salih,
Will, actually.
can you hear me?
Rob, can you hear me?
Yeah,
Yes,
sorry
I can
about
hear
that.
you now. It's okay. Rob just got off the plane not that long ago, but managed to was kind enough to join us. So thank you, Rob. I mean, we had one thing that I really wanted to ask you, because we had earlier on, we had Patricio talk about gas prices, I mean, and the gas crisis in Europe. And I know you had a note on solar demand following this crisis that's unfolding in Europe. So I wanted to get your kind of thoughts. I mean, I thought that was a very interesting note. Get your thoughts on and the expectations of solar demand growth this year and in the next couple of years.
Yeah, thanks, Salih. I've been listening in, and I think I would largely concur with some of the comments that Patricio just made a few minutes ago. But yeah, the expectation from us is that where we are in the gas market is just one of the factors that's going to really potentially nudge solar demand even higher. And if you haven't been paying attention to solar, it's just been growing at an incredible pace. Over the last 10 years, the compound annual growth rate for the global solar demand has been over 20%. This year, we think demand's going to grow 20 to 35%. And this is really largely built into expectations, in my view. So whether you're looking at Maxion Solar, Trina Solar, Canadian Solar, on down the list, the median sales growth expectation, according to consensus this year, is 41%. Now, some of that's higher panel prices, but the industry is just growing at this incredible pace. And it's really a sort of obvious conclusion, in my view, just to look at the gas market and say, well, that's going to push it even harder. And then in addition to just the market fundamentals, Patricio noted UK and German policy. And I would just note that I think just yesterday, the Danish government came out and talked about quadrupling both solar and wind demand by 2030. So there's just a lot of things that are happening in energy markets that are absolutely fascinating right now. And but I think solar is perhaps one of the most rapidly growing sectors to take a look at if it's new to you.
Thanks, Rob. And while we have you, because Patricio very briefly mentioned the UK long-term energy strategy as well, which came out since we last spoke. on here a couple of weeks ago. Wanted to see what your takeaways there were as well.
Well, yeah, I mean, I think what we're seeing is just a real wartime footing in Europe to really address the energy crisis. I think I'm reticent to use the word crisis. It's a bit of a loaded term, but prices are so high. There's potential gaps in the supply-demand balance, particularly as you look ahead to winter. And so I think policymakers are really trying to throw the kitchen sink at doing everything they can to reduce Russian gas reliance and help to protect consumers from rising energy bills. And renewables are just a big piece of that equation. The the UK plan also includes a pretty substantial build out of nuclear, but that's something that will come in the 2030s and 2040s. It's just such a long lead time. So in the very medium term, kind of 5 to 10 year range, we're going to see a lot of wind, a lot of solar. I think the UK plan calls for a staggering 50 gigawatts of offshore wind by 2030, if I'm remembering the numbers correctly. And solar is also part of the mix, despite not being a very sunny country. I think Patricio's got this really great, compelling chart. If anyone listening, if you haven't seen it, he's taken a look at the solar capacity growth expectations from all the major European utilities, and based on guidance. And his conclusion from the chart and looking through all of the guidance is that European utilities aim to grow solar capacity by a compound annual growth rate of 50% between 2021 and 2025. I mean, these are just staggering numbers. Find some other segment of energy that is growing anywhere close to that pace. I'd be happy to chat with you about it, but very exciting times from the wind and solar business. Perhaps a bit of a sad driver for it with the crisis in the Ukraine, but yes, I think we are quite bullish on both demand for solar and wind over the coming 5 to 10 years because of these circumstances.
Thank you very much, Rob. We actually have a couple of questions and a couple of minutes, so I think we'll go on to take those. One is for Will. It's following up on his comments on the free cash flow usage for energy companies for the energy transition activities. The question is, has this view been expressed by management teams specifically?
Yeah, thanks, Alan, and thanks for the question, Eugene. So I would say here that not specifically this has been dictated by management teams, but it is heavily implied. So for a few reasons. Number one is that the primary strategic objective that for the entire European peer group over the last few years has been debt reduction and deleveraging their balance sheets. This has mostly been achieved. We've seen rapid deleveraging, particularly last year, as a function of the free cash generation, big divestment programs, and also coming from reduced outflows resulting from cut dividend programs in response to the pandemic. Where management teams have been very clear is an increasing share of CapEx being deployed into transition businesses, and namely renewable power generation. As I mentioned earlier, some of the renewable power targets that these companies have are very large and ambitious. So we're talking utility level scale. Total is aiming for 100 gigawatts of gross capacity by the end of the decade. BP is at 50. So there's a lot of renewable power development that needs to occur this decade for this group if these companies want to achieve their targets. And I think just lastly, it's that these are very large companies that invest on long time frames, and the European peer group has limited short cycle exposure here on oil. So specifically in the U.S. shale patch, the only company with really any material exposure is BP with about 300,000 barrels a day, which is gas weighted in their BPX Permian unit. We've seen the Permian and U.S. shale forming a primary divestment candidate for the group. So there are limited short cycle levers here for this group to invest in to capture near term value from the pricing backdrop. Instead, they're typically investing in upstream on multi-year long lead time projects, which are not conducive to trying to optimize production in the near term. And so that's why it's very clear to me that this free cash flow obviously is not all going to be deployed into the energy transition. We're seeing big buyback programs. We're seeing further dividend recovery, but I think also energy transition M&A is a big target for this free cash flow deployment from the group this year and into next.
Thank you very much, Will, and thank you, Eugene, for that question. I know we got a couple other questions. I mean, Diego, your questions about coal, and Michael, your questions about agriculture. This is not really exactly what we focus on, but I have noted your questions down, and I will put you in touch with our colleagues who specialize in those fields, and we'll try to get an answer for you in your questions. We've gone over just a couple minutes over the half an hour mark, but I wanted to say thank you to Will, Patricio, and Rob for joining us, and thank you to all of you for joining this discussion. As always, if you have any questions, you don't have to wait for this call to ask. Please always feel free to reach out to us directly on your terminal or through email as well. So thank you very much for your time, and talk to you in a couple of weeks. Thank you.